Hello, welcome to the BVP 2020 EII Fund presentation, proudly presented by BVP Investments. In terms of the agenda for today, I'm firstly going to introduce BVP Investments and talk about the team here at BVP. I'll then talk about impact investing and our investment strategy. I'll also speak about our investment process and how it works from beginning to end. I'll then touch on 2020 and the year that it's been at BVP and the kind of stuff that we've been up to. And then I'll explain how the EII scheme works in detail. And finally, I'll finish by talking about our 2020 EII fund and some of the target investments that we have lined up. My name is Conor Duggan and I'll be today's presenter. I'm the investment director here at BVP, and if you have any questions that you'd like answered, please don't hesitate to contact me at conor@bvp.ie or by phoning me on 01657 2900. BVP Investments is an investment manager that is regulated by the Central Bank of Ireland. The company was founded by Elliot Griffin in 2004 and is based in Cornels Court in Dublin. At BVP, we are both a clean tech and impact focused fund manager, and the four cornerstones of our investment focus are as follows. The first is creating a sustainable global society. The second is transforming through digital technology. The third is building a healthy world. And the fourth is empowering humanity. I'll show in a later slide how some of our investments fit into these buckets. We at BVP have been managing EII funds since 2007, and we are now in the process of raising our 2020 fund, which is our 14th EII fund. We have raised 47 million to date from over 600 investors, and we've invested in over 40 companies. We have raised and managed bonds as well as EII funds and private placements too. The EII scheme is a revenue approved scheme, and we at BVP have always had a collaborative relationship with revenue. Our team has a rich mix of backgrounds across finance and industry, and we think this mix puts us in a good position to identify and manage our investments. The team at BVP is made up of 8 members as outlined here. David Gavigan is the chairman of BVP and has over 30 years of experience in venture capital, having previously founded Hibernia Capital Partners. Elliot Griffin is the managing director, and prior to founding BVP, he worked at Hibernia Capital with David. The rest of the team is made up of myself as investment director, Andrew McGreal as investment manager, Gillian Cregan as financial controller, and Conor Toolan and Ray O'Neill as investment advisors, as well as David Smead as a non-executive director. At BVP, we look to drive impactful change, and the way that we look to do that is across 4 kind of strands of impact investing. The first one is creating a sustainable society. So we look for companies that whose business plan, I guess, and his mission is to create a sustainable society. So a good example of this is a company called Urban Volt. And Urban Volt install LED lights into large corporates and finance them as well. So essentially, there's no upfront cost for the business, and they save both cost and emissions through the use of the LED lights. And they're a really good example of a company who are, helping to create a sustainable society while also being a genuine business. Optinergy is another one, who are a operations and maintenance provider for wind farms. And Green Generation is an anaerobic digestion plant based down in Nerney. And I'll talk about Green Generation actually a little bit later in this presentation. The second tranche is transforming through technology. So we look at businesses that are using technology to basically better the world. And some examples of this is Buy Me. So Buy Me is a grocery delivery company who essentially allow shoppers to get their groceries delivered from the retailers, so they work with Lidl and Tesco and Dunnes in Ireland. So essentially you can order through the app, and a shopper will go to the shop, pick up your goods for you, and deliver them to your door. Park P&P is another company who are using technology really well. So they have a kind of flagship product is Park Office, who work with large corporates to make their parking more efficient. So they've actually got huge demand recently because of COVID, and because people are now starting to come back to the office, and they want to make sure that all of the parking spaces are getting the maximum utilization. And it's their technology platform that's allowing them to be able to offer this service. The third strand is building a healthy world. So two good examples of this are Bleeper Bike, which is Dublin's first stationless bike sharing company, who we invested in last year. And they offer bikes to be shared by commuters, and while being able to commute in a very kind of affordable way, you can also get your exercise in for the day. Health Beacon is a medical technology company who are in the field of medical adherence. So they have a smart bin, which tracks adherence of medication for patients. So again, they're helping to build a healthy world. The final piece is empowering humanity. So two companies here that are definitely in that world are Tandem, which is a HR technology company. And what Tandem does is it allows continuous feedback from anywhere in the organization to anyone in the organization. So, the days of the traditional feedback mechanism where you met with your manager once a year, those days are over, and Tandem are allowing essentially companies to empower each other or their employees by giving them continuous coaching and feedback through their technology platform. Diona is a government services company who work with large government bodies to provide government service in a digital form. And some of the cases they work on are dealing with child services and replacing the need for kind of paper-based folders. So now they can do it all on an iPad, which saves a huge amount of time and can lead to much better outcomes. So I think the objective here was just to show how we drive impactful change, and all of our companies fall into one of these brackets, and the above just shows a sample of the companies and how they fall into the brackets. So in this section, I just want to talk about the criteria that we look for when we're making an investment. So the first piece is EII's compliance. So it's very critical for us that any investment that we make is EII's compliant. And although the legislation has changed recently, where the onus is on the company to state that they're qualifying, we spend a huge amount of time at BVP working with companies to make sure that they are indeed compliant, because even though the penalty is with the company, obviously as a shareholder we suffer as well, and it's definitely not something that we want to do, is to invest in a company that's not qualifying. So we spend a huge amount of time looking at that. The second thing, I suppose, is strong management teams, and what we really want to look for here is kind of a collection of people that are working together, that are individually really strong, but that work really well together as a team. And the reason that's important is because sometimes we see opportunities where there's a really strong CEO, but no matter how strong a CEO is, him or her can only do so much. So we've seen in our experience that the best companies have really broad, really strong individuals within the team, and it makes a huge difference. That kind of ties into the third point, which is the proven track record of success. So what we typically like to see is hopefully, the company's at a stage where it can show a track record of success. But if that's not the case, then we want to see that the management team, either collectively or individually, have had a track record of success. So that's success, hopefully in the same industry that they're in, and that definitely goes some way towards, kind of us feeling like this, it could be a potentially attractive investment. And the fourth point about the revenue generating. So we really want to see companies that are generating a significant amount of revenue, and to have a clear path to profitability. So the companies don't need to be currently profitable, but there needs to be a very clear path as to how they are going to get to profitability. And we spend a huge amount of time analyzing those plans. And this point sort of goes back to the point about the strong management team. So what we really like to see is a company that presents itself and says, we're doing X amount in revenue, we're losing Y, but we're going to get to profitability, and this is how we're going to do it. And it's always really, really good to see how the tasks or the plan that's laid out is kind of spread across the team. So again, it doesn't just rely on one person saying, I'm going to go out and close all these sales and, do all this stuff. It's ideal when you see that, everybody is carrying their fair share. The next point about the large market size. So, I suppose it's easier to compete for any business the larger the market, and particularly if it's growing. It's always good to see as well. But it's there's two other points that are important to note, and one is that the larger the market is, and the quicker that it's growing, the less market share you need to take from incumbents. So essentially, everyone can win in a market that's growing quickly. And the second point is about attracting either co-investors or future investors. So oftentimes when we look at a proposition, we think about, okay, well, is there other investors who are interested in investing in this? And if there are, that's great. But sometimes equally as important is what's the next step. So, a lot of times the proposition comes in and they say, we need an investment for the next 12 months to get to this level. And then when we get to this level, we're going to raise a Series A or a Series B or whatever the case may be. And, it's really important that when we consider that the larger the market and the quicker that it's growing, the more, I guess, credible it is to think that there will be further funders who will be interested in the opportunity. The next point is about competitive advantage. So competitive advantage is very important. I think we really spend time kind of getting to know the industry and getting to see that there is a genuine competitive advantage in the company. And I think one of the best ways one of the best things we do to kind of test that theory is to talk to other people in the industry, or even to talk to competitors, because every founder probably thinks that they have a competitive advantage, but it's only when you actually get out and try and get some independent evidence that you can really make a judgment on whether they do indeed have a unique competitive advantage. The next point is exit opportunities. So these typically come in two forms. It's either the company is buying back the shares from us after the minimum holding period, or the company itself is bought. And so we spend a decent amount of time looking at, the cash flows for the company in the coming years to see, will they have sufficient cash to buy back our shares, and will they be able to do that in a realistic time frame? And then secondly, what's the likelihood that the company is going to be bought, and who would be interested in buying them, and why would they be interested in buying them? So I think, anytime we look at an investment, one of the first things actually we really think about is exit opportunities. And then as we get further down the line and we get into the legals, we structure our legals in a way that gives an incentive to the management team, or to the company, to buy our shares out as quickly as they can after the minimum holding period. The final point is actually a really important one. It's just about, we look for products and services that solve a real problem. And what we mean by that is, it's very, very common when, a promoter or a founder comes in and they show a product that, to the guy in the street, it seems like it makes total sense. But, having a nice to have isn't good enough. And it's been our experience that nice to have products don't sell. You need to have a need to have product. So it's something that's solving a real problem, not just kind of a, wouldn't it be great if we could have that. We really look for stuff that, you know, are transformative in terms of the value that they add. And that definitely, we think, gives a company a really good chance of success. So this is just an overview of the criteria we look for when we're looking at investments. So this slide here just gives an overview of the BVP investment process. So the process starts with origination, which is kind of a fancy word for new leads coming in. So new leads or new investment propositions come in a variety of ways. So some of them come directly to us through either our website or direct emails. Some of them come through founders, so founders that we've invested in who know other founders who they think might be interesting. They also come through other investment companies, so there may be other venture capital or other investment groups in Ireland who have existing investments and they're looking to raise a bigger round, and they may approach us. Or sometimes it comes through corporate finance advisors. So corporate finance advisors would come to us and say, we're working with this company and we think they're worth having a look at. The other way, and sometimes a really good way of getting leads, is when we at BVP spend time reading about an industry and about companies that are up and coming, and we approach them and basically, you know, explain who we are and kind of start the process there. So the second step then is deal flow management, and deal flow management is a kind of a spectrum. So you start off with the introduction and it goes all the way through to completion. So companies, you know, will sit in somewhere on the spectrum throughout the process, and sometimes it can kind of move back and forwards. So why that would typically happen is because we may talk to a company and we may like the company and think, you know, it's a really interesting proposition. But as we do a little bit more diligence, we realize that, you know, we'd love to see them achieve a certain milestone before talking further about investment. So we would talk to the company and say, you know, we really like what you guys are doing, but it would be great if you could have X done by, you know, the next time we speak. What that does is, for us, it gives us more time to kind of build a relationship with the company. And it also gives us an insight into the management team and sort of how capable the management team is. So can they deliver on the objective we've set them? And it also kind of de-risks the investment to some degree as well, because they've achieved a milestone before our money has gone in, which is always good to see. So the next step then is due diligence, and the due diligence, this kind of due diligence is kind of what I call preliminary due diligence, which is done before our term sheet is sent out. So a term sheet is essentially like a heads of terms that outlines a broad agreement about a proposed investment. But we would do a significant amount of due diligence in advance of that. So once the term sheet is sent out and it's signed, we then go to our investment committee. So before we go to the investment committee and make a presentation, we do detailed due diligence. So we would do a lot of financial due diligence. We would talk to customers in the industry, other people in the industry, do some background research on the founders, kind of identify any of the key risks that we see in the business, and kind of some ways build a collaborative relationship with the founders and discuss these things. And I think actually talking to the founders about the key risks and concerns can sometimes be a very good way of you know, us understanding the business better. So once it goes to investment committee, it either is approved or denied or kind of sent back for further work. So assuming that the investment is approved, we then go on to the legal negotiation. So the legals are a suite of documents that we use to protect ourselves essentially and our investors, and to lay out the things that the company can do and the company things that they can't do without our consent. So we typically like to have some level of control around the company and certain things they can do and can't do. And within the legals as well, we'll have mandates in there about exits and expected timing and how the exit works. And then once the investment is completed and the funds have been transferred, We then engage in monitoring and support. So throughout the life cycle of the investment, we'll play we'll be very involved. So in our typical investment, we'll look to take a board seat, and we try and build a relationship with the company whereby we're getting, all the information that we need, but we're actually adding value as well. So ideally what we want is, to be able to bring our expertise and our network to each of these companies to help them grow and build a very collaborative relationship. So I hope that gives a good overview of the BVP investment process. So this slide, I just wanted to talk about the investment oversight that we bring. And I think it's split into two sections. So the first is a supervisory role. So in our capacity as investment manager, once we've completed an investment, we look to enter into a kind of supervisory role with the company. So what does that mean? That means that we hold the management to account. So essentially we have regular board meetings, and management are expected to do what they said they were going to do, and to provide challenge. So providing challenge is kind of testing thoughts and plans that the company has to see is everyone aligned in what the best steps forward are. Monitoring financial reporting and overall compliance. So that's about, is the company reporting satisfactorily? Are we getting management accounts on a timely basis? And if we're not, then, we need to have a discussion about how that can be improved. And then I suppose the last piece is just to seek assurance that the strategy and performance are on track. So, we want to play a collaborative role with the company, but we also want to make sure that the strategy that we set out, or that the company set out, is being adhered to, and performance is being followed as well. And if it's not, then there's a reasonable explanation as to why it hasn't been followed. And then in terms of our stewardship role, I think our stewardship role is to help guide and shape the business, to help shape strategy, to establish the company culture, values, and ethics, and then really importantly to determine performance targets. So, we feel like it's really important to have a relationship with companies whereby performance targets are set that are, ambitious but not crazy. So they're achievable, but they're a stretch. So on this slide, I've included a number of investments that we made with the 2019 EIIS fund, just to give you a flavor of the type of companies that we look at. So the first company there is a company called Kinsen, which was founded by Mark Little and Anya Kerr, who were previously founders of Storyful, which was sold to News Corp. And Kinsen is a media technology company, which, they have a primary product that works with platforms. So it's Microsoft, Google, Facebook, Twitter, Spotify, those kind of platforms, where they help the platform essentially fight against misinformation and high-risk content. And they are a software that the platform employs to basically act as an early warning signal against high-risk content that may try and appear on the platform. The second company is a company called Buy Me. It's a grocery delivery company, and this is our second investment in Buy Me. We invested with our 2018 fund as well, and we went in as a part of a Series A round, which was giving them the funds they needed to expand into the UK, which they've done, into Bristol, and to expand further afield into Ireland, which they've done by expanding into Cork. Food Marble is a health technology company, so they have a handheld device, which is the first of its kind in the world, which is a device that reads or analyzes the hydrogen that's emitted in your breath. And the reason that's important is because there's a direct link between the level of hydrogen in your breath and what's happening in your gut. So people with irritable bowel syndrome and other kind of digestive conditions can use Food Marble to basically help treat the condition they have. So they have both a clinician or a clinical product and a consumer product, and they're selling that through Amazon and their website and through hospitals in the case of the clinical products. And they're also selling in Best Buy in Canada with the hope of going to Best Buy in the US very shortly. Versono is another medical technology company who essentially have a device that uses ultrasound to blast through calcium lesions in veins. So these are typically blockages that occur in the lower limbs, and because there's no current treatment for this, it normally it ends up with amputation. So their device can make a hole in the lesion, which then means that the surgeon can treat it and doesn't have to be amputated, which is obviously a good outcome. Another company is Johnson Hanna, who are a legal services provider, who we recently invested in. And they are kind of reinventing the world of legal services by partnering with barristers to do kind of non-opinion based legal work. So they work with major law firms on projects where they do a lot of the heavy lifting that needs to be done in terms kind of things like discovery and that kind of stuff. So some of the clients they're working with at the moment include Quilcha, Irish Water, Duns, Bank of Ireland, Ryanair. So they've definitely got some blue chip customers on their list of clients. And then this other company that's a recycling company is a company called FPD. And what they do is they have a robotic machine which recycles flat panel displays. So flat panel displays are like your laptop, your smart TV you may have in your home. Recycling them is a big problem because right now most people it's a human-based thing, which is very dangerous. It's very slow. And it's high risk. So what these guys have developed is a robotic machine which automatically separates the glass from the plastic, and more importantly separates the mercury out, so it can be disposed of safely. But the other thing that it does is it breaks out the components of the screen into separate parts so the recycler can then resell them on, whereas the current system that's used is essentially just a big grinder where all the end product is mixed together and has no use. So those are just 6 of the companies that we've invested in this year, and we're working on 2 other companies, which I'll provide more detail on once we close them. But I suppose the important point here is that it gives you a nice kind of snapshot of the type of companies that we at BVP invest in. And one of the important things to note is that there's a high degree of diversification across each of these businesses. So the businesses are all in different industries at different stages of development, and we think that gives us a really nice balance in terms of being diversified sufficiently across different industries. I wanted to spend some time speaking about COVID-19 and the impact that it's had on both our portfolio companies and our investment strategy. Thankfully, we hadn't completed any of this year's investments by the time the pandemic hit, and that meant that we could reevaluate our investment strategy, and meant that we had to discontinue some conversations with potential companies and accelerate others. It also meant that it allowed us to see in real time how the prospective companies that we were looking at were handling the crisis, and then we were better able to make informed decisions about whether to invest in those companies or not. Our existing portfolio was impacted in the same way as every business in Ireland, but I must say that overall we've been really impressed with how our portfolio companies have reacted. They were able to reduce overheads in the short term, access additional funding quickly, and in some cases transform their product and service offering to fit the new environment. The pandemic is still very much at the front of our minds, and will definitely have a major impact on our investment focus for 2021, which I'll discuss in more detail later on. So thankfully, 2020 has been a good year so far for BVP, with lots of activity across our portfolio. which I'll discuss in a bit of detail here. So, in some of the positive news, one of our portfolio companies, Urban Volt, closed a Series A round of 7 million, and they raised money from a combination of ISIF and Stephen Vernon, and that's going to give them the money they need now to basically go after the US market and to build out the team. Buy Me closed a Series A round of 6 million, and we actually were included in that from our last fund. And they have since launched in the UK, and they're now in Bristol in the UK, and they've recently launched in Cork as well. And they've just signed a partnership with Duns as well, so they're going to do a nationwide rollout with Duns, which is great news. In terms of other portfolio companies, Diona and Park BNP are two examples of companies that kind of reacted really well to COVID, and actually were able to make very significant commercial progress. So Diona is a government services company, and they were able to sign some big state contracts in the US, and Park BNP were able to make some very good progress with their product Park Office in the US, and they're actually talking to a lot of big tech companies over there about using their parking service with them, so that's pretty exciting. Another company which I wanted to highlight is Health Beacon, who are a digital health company. They signed a deal recently with the NHS, and they've also signed a number of deals with major pharmaceutical companies in the last couple of months. And they recently just appointed a very kind of senior CFO, which was definitely very welcome. And they made some really key additions to the board as well, including the appointment of Mary Harney, which was great to see. In terms of exits, it's always, I suppose, good from our perspective when you can talk about exits. And here's just 4 exits that have happened this year or are in process. So the first one is Green Generation, which is an anaerobic digestion plant based down in Nerney in Kildare. And we got a very decent exit there this year. And Carrick-Allen is a wind farm, which also returned a very attractive return. Ecofix is an energy efficiency contractor for residential homes, which we received a good return there too. And Optinergy is a wind farm operation and maintenance service provider, and we're working on an exit there, which hopefully we'll have completed by the end of the year. So that's just a snapshot of some of the good stuff that we've been doing this year at BVP. So what is EIIS? EIIS stands for the Employment and Investment Incentive Scheme, and it's a revenue-approved scheme which was designed to be a source of equity funding for Irish small and medium-sized enterprises, and also to give investors tax relief as an incentive for investing in these businesses. So the tax relief is aimed to encourage individuals to provide equity investment, so it's unsecured, it's an equity investment, it's not debt, into Irish businesses, which will hopefully grow and create jobs and pay tax in the future. So the relief is a deduction from total income, so you can write it off against your taxable income. And the part of the criteria is that the investment is held for a minimum of 4 years. And in 2018, 48 million was invested through the EIIS scheme across a total of 37 companies. So who is the scheme suitable for? The scheme is suitable for anybody who has a taxable income liability in the year that the EIIS investment is made. And taxable income can come from a variety of sources, including PAYE earnings, rental income from properties, other investment income such as dividends, as well as pension income. This slide provides a practical example of how a typical EIIS investment works. In this example, an investor has taxable income of 78,000 and wants to invest 40,000 euro in an EIIS scheme. The column on the left shows how the tax payable is impacted by an EIIS investment. The column on the right shows how the tax payable works if no EIIS investment is made. As you can see from the left column, the entire investment amount of 40,000 can be applied against the taxable income of 78,000, which reduces the taxable income to 38,000, which, assuming the normal tax bands apply, will mean that the investor will pay tax of €4,840. In the other scenario, the net tax payable is €20,840, which means that the investor on the left has saved 16,000 in tax, which equates to a return of 40%. So this slide shows how a typical fund works in terms of timeline. So if we imagine that the 2020 EIIS fund invests in 3 different companies. So company A, we close that investment by the 31st of January, and then the company has spent 30% of the money they've received by the 30th of April, they'll be able to issue a statement of qualification on the 31st of May. For the second company, let's imagine we've closed that investment on the 31st of March, and by the 30th of June, they've spent 30% of their money. They'll be able to issue a statement of qualification by the 15th of July. If for the third example, company C, let's say we close that investment on the 30th of June, and they've spent the money by the 31st of October, it would be reasonable to expect that they'd be able to issue a statement by the 30th of November, which will be the final investment we've made. So we now have all of the individual certificates that we need, and we would then expect to be able to issue a statement, a consolidated statement of qualification to investors by January 2022, and that will be able to be used to claim tax relief. On this slide, I want to discuss the redemption and exit mechanisms. Assuming that an investment has existed for longer than the minimum holding period of 4 years, and that the investor has got his or her tax relief, they'll now want to liquidate their position. Although all of the scenarios on the list are possible exit scenarios, the most likely are acquisitions, a trade sale, or a redemption by the company themselves or by the founders themselves. It's not uncommon under EII schemes to have a fixed coupon which can act as an incentive for the company to buy back shares at the end of the minimum holding period, especially if they believe that those shares are now worth more and can be worth more in the future. There is a range of measures that investment managers can employ to encourage companies to buy back their shares at the end of the 4 years. Before the Finance Act, put and call options were allowed, and under the new EIIS legislation, they're actually not allowed anymore, but instead investors can invest in preference shares, which give equal protection. I wanted to speak here about some recent high-level changes that's been made to the EIIS legislation that's quite important. So the first one is around the level of relief. So in the old scheme, it used to be 30% relief was provided in the first year, with a further 10% provided in year 4. But since the 8th of October 2019, investors now receive 40%, so their full tax relief in the year that the investment is made. Another change has been that the limit has been increased to the higher amount. So the annual investment is now increased from 150,000 to 250,000 from the 1st of January, and up to 500,000 in the case of investors who are willing to invest for a minimum holding period of 7 years. The final change is from the 1st of January 2021, investors who invest in a designated fund can claim relief in the year that they invest in the designated fund. This is a change from the previous scheme whereby investors had a choice between claiming relief in the year that they invested in the fund, or claiming relief in the year that the fund invested into companies. So in other words, investors in the 2020 EIIS fund can claim relief against their 2020 income tax and can then carry forward relief that's not used for 2021, but they can't choose to claim relief for 2021 if they have a liability for 2020. I've included some frequently asked questions on this slide, which I hope you find useful. The first question is about whether an investor can exit his or her investment during the 4-year minimum holding period. And the answer is no, as an early exit will result in a clawback of any tax relief obtained. A second question that we receive quite frequently is whether the investor will own the shares in the company that receives investment. And yes, they will. For designated funds like BVP, the shares will be held by a trustee on the investor's behalf. In terms of the year that the investor can claim relief, as a result of the recent change to the legislation, relief can now be claimed in the tax year of 2020, and any unused claims can be carried forward to subsequent years. In terms of the minimum and maximum investments for this year's fund, our minimum is €10,000 and our maximum is €250,000, and that applies per person, so a couple can avail of €500,000 relief in total. I wanted to let you know that our 2020 EII fund is now open and will remain open until the 31st of December 2020. Our fund will be split across operating businesses and projects, and we already have a number of potential investee companies that we are in discussions with about potential investments in 2021. The minimum investment amount for the fund is €10,000 and the maximum investment amount is €250,000. The targeted return for the fund is 15% IRR. The investment themes will follow closely to what our traditional themes have been, and we believe that we have a pipeline of projects and operating companies that will make up a very attractive fund for 2020. If you'd like more information on the 2020 fund, please don't hesitate to contact me, and I can share the 2-page document that we have, as well as other marketing material that we have too. In terms of plans for our 2020 EII fund, we've identified a number of suitable candidates for our fund, and there'll be a mix of project type investments and growing Irish businesses. We're at a very advanced stage in discussions with a wind farm operator in the west of Ireland. And he's got a site with full planning and has been successful, or made a successful bid in the recent Renewable Electricity Support Scheme, or RES, auction, and now has a contract to supply electricity to the grid for 15 years at a fixed price. This investment will be an anchor investment for our fund, and we're actually aiming to use this investment as a template for other wind projects, as we're working on an active pipeline of other similar projects which may also be suitable for the 2020 fund. Another project type investment that we're looking at is a hospital waste treatment plant, which will be based on the grounds of a number of Irish hospitals, and it will clean hospital wastewater and convert organic materials into energy. The company is at advanced stages with a number of different hospitals, and we at BVP have been in discussions with this company for some time and feel that we're close to getting a deal agreed. Another company that we're at advanced stages of discussion with is a company that's developing and operating a range of sustainable energy projects in partnership with the end client. They're currently working on a number of different projects with both farmers and large corporates, and they'll provide a variety of services that will enable both to reduce their emissions and also to save money, which is obviously a win-win for everyone. We've worked with the founders before on other projects we've been involved with, and we think they're a very strong candidate for 2021. Other companies that we're speaking to at the moment include a restaurant delivery and technology company who make delivery much more efficient and economical for restaurants. They currently have customers in Ireland, the UK and the US, and they're in the process of signing major contracts with major restaurant groups in the UK and the US. Finally, the transport company they were speaking with have developed and commercialized car sharing technology that makes it much easier to book and access vehicles. They have existing contracts with some of the largest car companies in the world and will use the investment from us to grow out their team so that they can roll out their product on a global scale. So we're in active discussions with each of the companies listed here and feel that each of them meet the criteria of our investment criteria as outlined above. On this slide, I wanted to speak about BVP's fund performance. The 2020 fund has a targeted return of 15% IRR, including tax relief of 40%. And we estimate that the holding period will be between 5 and 7 years. And so what that essentially means is that we're expecting to provide our investors with a return that equates to 15% per year. And we expect to be fully divested from each of the portfolio companies between 5 and 7 years after the fund has been raised. In terms of historical performance, since 2013, BVP EII's products that are outside of their minimum holding period have generated average returns of 157%, including invested capital and tax relief. So you can see in the box to the right that our returns to investors are made up of 3 buckets. The first is tax relief, which is 40%. The next is cash distributed to date. So this is actual exits that we've received from the companies, and we've now returned that money back to investors. So each time that we get an exit from a company, we distribute that money directly back to the investor. So we don't hold the money from all of the exits and then give it back in one lump sum. As soon as we get an exit from a company, we essentially distribute that money back to our investors. And then the remaining value, which is in the green, is the book value. So this is where we have investments that are still remaining in companies. And this isn't a bad thing at all. So there's still significant value in these companies, even though we haven't got an exit just yet. So probably 2 good examples of this are Urban Volt and Health Beacon. So Urban Volt, we invested in with a number of funds, and they've just closed their Series A. And they're now going to the US, and they have a very strong pipeline heading into 2021. So we believe that we'll get a very valuable exit from that company in the coming years. And likewise, Health Beacon have made significant progress in 2020 and definitely have a very bright future in 2021. And while our investment is still in the company, we believe that over time we'll get an exit that will more than compensate our investors for the extended holding period. In terms of our average holding period to date, it's been 5.7 years, which is almost exactly between the 5 and 7 years that we're expecting for our 2020 fund. Before we finish this presentation, I wanted to give a quick comment on the outlook for 2021 and how we see the impact on an EII's investing. While 2020 has been a year that most of us will want to forget, the general consensus for the outlook for 2021 is positive, and general economic forecasts for global growth are around 5% for 2021. Irish growth in 2021 is forecasted to be between 1.4% and 5.6%, and the central bank released figures this week with forecasted GDP growth of 3.4% in 2021 in the base case and negative 0.3% in the severe case. It's interesting to note too that the EII released statistics recently that savings were likely to be 20% of income on average in 2020 as opposed to 10% in 2019, which means that there could be a surge in demand in 2021 and a V-shaped recovery. While we definitely don't claim to have any crystal balls, I think there definitely is room, or there's reason for optimism looking into 2021. As much as 2021 has been a challenging year for all of us, We at BVP have been really impressed by how our portfolio companies have reacted to the challenge. Not alone were they able to restructure their operations in the short term, but they were also able to access funding, and in a lot of cases were able to pivot their service offerings to suit the new environment. It's been a challenging year for everyone in business, and we've been really impressed with how our portfolio companies have faced up to the challenge. In terms of our investment strategy for 2021, we'll be slightly more conservative given the uncertainty that remains, and we'll construct our portfolio across both projects and operating companies. As a result of the recent RES auction, there are a number of wind projects that are looking for EII funding and are also looking to partner with local communities, and we see a huge opportunity here. So one of the big focuses for BVP and the 2020 EII fund will be on sourcing these type of projects which we can invest in 2021. There's also another array of projects in other sectors that we're very familiar with, including solar and waste management. So we believe that for the 2020 fund, there will be an abundance of opportunities to invest in projects. And one of the reasons why we like projects is because it lowers the risk. And so while we're going to be slightly more conservative, we feel that if we get the right mix of projects and operating companies, we think that we'll have a very nice fund going into 2020. We'll have a very nice fund by the end of 2021. If you'd like to make an investment in our 2020 EII fund, we have a tax calculator on our website, which can be used to calculate the tax relief that you'll receive based on the amount you wish to invest. And if you'd like to contact us for further information, including our investment pack, please email hello@bvp.ie, or you can email me at connor@bvp.ie, or alternatively, you can call the office at 016572900. This year, we're offering both a physical and digital application form, and that's going to come through our online platform, DocuSign. And in terms of payment, we accept personal checks, bank drafts, and EFTs. And in terms of AML, we'll look for identification and proofs of address. And we can use our system IDPal to do that, which is an electronic system and is actually really, really quick in terms of how quickly you can process the information. So again, if you'd like that information, please either email me or hello@, and I can send you out a link to both of those. I'd like to take the opportunity now to thank you sincerely for attending. I hope you enjoyed our webinar, and if you have any questions, please don't hesitate to contact me at connor@bvp.ie or to call the office on 016572900. And of course, feel free to visit our website at a time that suits. Thanks.